How to understand spinning top and doji and what are the differences? These two types of candlestick are neutral patterns. First, a spinning top candlestick is a type of candlestick pattern that indicates indecision or uncertainty in the market. It has a small real body. It's the area between the open and close prices. It is also relatively long upper and lower shadows. This is the lines extending from the body representing the high and low prices during the period. In fact, the small body signifies that there is little difference between the opening and closing prices, while the long shadows indicate a wide trading range. Then, the spinning top can be either bullish or bearish, depending on the color of its body. A bullish spinning top has a green or white body, the close price is higher than the open price, while a bearish spinning top has a red or black body, the close price is lower than the open price. The appearance of a spinning top candlestick suggests that neither buyers nor sellers could gain a dominant position during the trading period, resulting in a standoff. This pattern often signals a potential trend reversal or a pause in the current trend, as market participants reassess their positions. To be honest, traders typically look for confirmation from subsequent candlesticks or additional technical indicators before making trading decisions based on a spinning top. Now, let's take a look at another type of neutral candlestick. A doji candlestick is a type of candlestick pattern that signifies indecision and potential trend reversal in the market. It is characterized by having a very small or non-existent body, which means that the opening and closing prices for the period are almost the same or equal. The doji candlestick can have varying lengths of upper and lower shadows. This represents the trading range during the period. Now, there are four common types of doji candlesticks. First, the basic doji. The upper and lower shadows are of similar length, reflecting a balanced tug-of-war between buyers and sellers. Second, the long-legged doji. This doji has long upper and lower shadows, indicating a larger trading range and heightened market indecision. Third, the dragonfly doji. In this type, the open and close prices are near the high of the period, with a long lower shadow and no upper shadow. This pattern may hint at a bullish reversal after a downtrend. And finally, the gravestone doji. In this case, the open and close prices are near the low of the period, with a long upper shadow and no lower shadow. This pattern may suggest a bearish reversal after an uptrend. But, do not forget that a doji candlestick on its own does not provide a strong trading signal, as the market's direction remains uncertain. In effect, traders typically look for confirmation from subsequent candlesticks or additional technical indicators before making trading decisions based on a doji pattern. Finally, when a doji appears after a noticeable trend, it may indicate that the trend is losing momentum and a reversal or consolidation may follow. Thanks for watching.